Hey everyone, it is Julie here with TipRanks, and today we're taking a look at 3 stocks that are trending this week, but not necessarily in a good way. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. Today we're taking a look at 3 popular stocks that are trending with Wall Street Analysts this past week. However, today we're not looking at stocks that are trending with buy ratings. These instead are picking up a lot of holds. So we're going to take a look at what's been going on with these companies lately and why Wall Street Analysts are feeling more cautious about the stock's future. Of course, we found today's stocks using the trending stocks page over on TipRanks.com. Found under research tools, here you'll find companies that have been gathering the attention of multiple Wall Street analysts. You can sort by most, best, or worst rated, and during what time period you want to look at. And here I noticed a few coming in with a lot of hold ratings. So let's not waste any time and jump right into these trending stocks, starting off with technology company Intel. Their stock trades under the ticker INTC, currently priced at $35.51. Now, in the past year, they have seen growth of 1 year, but zooming in a little closer, we can see some ups and downs in the last few months, fairly flat there, but they did take a big jump up here after their earnings on October 26th. Up 4% in the last 5 days, they've been trading fairly flat since. So with a jump up like that, you would expect a positive earnings report, and yes, Intel did come out with an earnings beat. For their third quarter, Intel reported earnings per share of 41 cents, coming in comfortably ahead of analyst expectations. On the revenue side of things, they came in at $14.2 billion. Now, this did beat estimates, but it was down 8% year over year and marked their 7th consecutive quarter of declining sales. Their CEO said that they had a standout third quarter underscored by across-the-board progress on their process and product roadmaps, agreements with new foundry customers, and a momentum as they bring AI everywhere. The CFO noted that their results exceeded expectations for their 3rd consecutive quarter, with revenue at the high end of their guidance. And even the future guidance provided by the company came in ahead of analysts' expectation. So the jump in stock price makes sense. But why do we have so many hold ratings coming in from Wall Street? Well, one analyst with a hold rating is Stacy Rasgon from Bernstein, and they said that their rating is driven by a blend of both positive and negative aspects. On one hand, Intel's Q3 results exceeded expectations and gross margins were robust. But on the other hand, Intel's data center performance continues to face considerable challenges in both revenue and profitability. It appears that the company is likely losing market share in that area. And they say that the company's AI narrative is still relatively weak, and the company continues to burn through cash. Overall, they think there are still significant hurdles for Intel to overcome. One other analyst from Baird also weighed in. They noted that Intel is well entrenched in a revenue and gross margin recovery post a first quarter trough. However, despite strong execution recently, Intel continues to face formidable challenges, including generating sufficient revenue growth to fund future node migrations, initial inroads for ARM-based architectures, and possible challenges ramping new node production in much higher volumes than what Intel will ship with Intel 4. Currently, the Intel stock has 28 analyst ratings, with majority of those coming in as a hold. With 5 buy ratings, 19 holds, and 4 sell ratings, the average price target comes in above $37 per share, which would be an upside of nearly 5.5%. Down below, we can see all of these ratings have pretty much come in following that last earnings report. On the low end, we do have a sell rating with a downside of nearly 52%. A lot of holds coming in with some slight upsides or downsides, and one high-end price target from Northland Securities with a bullish outlook and an upside of 58%. Our second trending stock is Texas Instruments. Their stock trades under the ticker TXN, currently priced at about $140 per share. And you can see they are in the red this year. Over the past 1 year, down over 10% on a pretty steady decline here, especially in the last few, down 21% in the last 3 months. And that continued here this past week. We had one jump up on the 26th, but cooling off ever since. Now, for their latest quarterly report, results were fairly in line with expectations. However, their Q4 guidance was disappointing, as they're seeing weakening demand and falling margins. For their third quarter, Texas Instruments reported earnings per share of $1.85, and that did come out 3 cents ahead of analysts' expectations. Revenue came in at $4.53 billion, and that was flat sequentially and decreased 14% from the same quarter a year ago. They said that during the quarter, automotive growth continued while industrial weakness broadened. Following that earnings report, one analyst from Morgan Stanley has given the stock a sell. Analyst Joseph Moore noted that Texas Instruments continues to lag behind its competitors in terms of revenue and profit margins. The firm is also facing significant headwinds, which are expected to persist. In particular, the company's performance had been negatively impacted by its inventory issues, which appear to be more severe than competitors. Analyst Christopher Danley from Citi came in with a hold rating. He said that their lower utilization rates and higher depreciation are negatively impacting their margins. Moreover, the weakness in the industrial sector, which accounts for 40% of their sales, is broadening, and the auto end market, representing 25%, is expected to correct in the fourth quarter. The anticipated lower demand, utilization, and higher depreciation are likely to keep sales, margins, and earnings per share under pressure. Their stock currently has 20 analyst ratings and does come in with a hold overall, but has a few more buy ratings in there. Those ratings break down to 6 buy ratings, 11 holds, and 3 sells, with an average price target just shy of $163. That would be an upside of over 15%. Down below, you can see all of our mixed opinions here. We have a couple sell ratings, and on the low end, a hold with a downside of over 7%, a lot of holds with upsides in the low teens, and a high-end price target of 49% upside from benchmark. And third, we're looking at Snapchat parent company, Snap. Their stock trades under the ticker SNAP, currently priced at $9.71 per share. They've had some ups and downs this past year, overall down 3%, did have a peak here in July, but have been cooling off since, down 15% in the last few months, and down over 4% in the last 5 days, but trying to climb back a bit in the last couple. And of course, all of these analyst ratings flooding in are following a recent earnings report, where Snap did come out with a beat on both earnings and revenue. However, there is some caution moving forward due to the conflict and war in the Middle East. For their Q3, they reported a loss per share of 23 cents, which was 1 cent narrower than analysts had expected, and revenue increased 5% year over year to $1.19 billion. They also saw their daily active users increase 12% year over year to 406 million. Management did note that due to the unpredictable nature of war, they thought it would be imprudent to provide formal guidance for the fourth quarter. Weighing in on the Snap stock with a hold rating is analyst Brian Nowak from Morgan Stanley. Despite Snap's better-than-expected third-quarter revenue, they identified significant uncertainties that prevent a more positive outlook. Notably, they call for further progress from Snap's largest advertisers in the U.S., evidence of Snap's ability to scale ad buys across a wider range of advertisers, and a robust ad product pipeline to fuel faster growth. Also weighing in on the stock with a hold rating is Josh Blackledge from TD Cowen. He is concerned about the recovery of Snap's advertiser base, especially larger advertisers who were most impacted by the changes in the advertising platform. He's looking for signs of incremental spending from these advertisers and is interested in the company's future operational expenses and profitability, particularly considering the recent closure of its AR enterprise business and increased infrastructure costs. The Snap stock currently has 24 analyst ratings, with a large majority of those coming in with a hold. The stock has 1 buy rating, 20 holds, and 3 sells, with an average price target just above $10 per share. That would be a slight upside of 3.8%. Down below, we can see all of these analyst ratings being assigned or reiterated this past week. We do have some sell ratings with a big downside of 27% here. Holds here are ranging from slight downsides to slight upsides, some in the low teens, and 1 bullish buy rating coming from Loop Capitals with an upside of 45%. So there we have 3 stocks that are trending with Wall Street analysts, but unfortunately trending towards the hold side. Now, I know you guys might be wondering what a hold means. The best way I've heard it described is basically if you own the stock, maybe don't sell, but if you don't own it, maybe don't buy. It's kind of a wait and see what happens spot. So let me know your thoughts on these 3 companies and which direction you think their stock is going to go from here. I always love hearing from you guys. Thanks so much for watching. Please make sure you always do your own research and due diligence before making any investment decision, and stick to your own investment plan. Have a great day, and I will see you back here next time.